Hey, thanks, David. Tonight I'm going to talk about what happened in the markets last year. I'm going to try and diagnose why economic growth has been so slow. I'm going to offer two treatment options, one from Donald Trump, some of our own, and then we're going to look at some investment strategies in this environment. So let's look at the markets last year. S&P 500 was up about 12% last year. TSX actually was up 21%. But the market in the US was not up in a straight line. In fact, if you look early in the year, it was down as people worried that US was going into recession. Market rallied as not all stocks went up. However, it was mainly yield-based stocks in this search for yield. We had that Brexit move down, and again, you see the market recovered very quickly after Brexit. Market was actually fairly flat leading up to the US election, and there was a lot of uncertainty. Donald Trump was elected, and you saw the markets rally, which is the opposite of what many people would have thought. We're going to want to talk about that. Turning to the US bond market, this is showing US Treasury yields, and it was much the same story. You see early in the year, yields traded lower as there were concerns about recession, and then continued to go lower as we had that search for yield. Yields bottomed out, and you see again that Brexit impact, bottomed out, and then started to move higher leading up to the US election. Again, you saw Donald Trump elected and yields jumped higher in that so-called Trump bump. Looking at the economy, you can see Purchasing Manager Index. Anytime Purchasing Manager Index is below 50, it means the US manufacturing industry in the US is contracting. And you can see early in the year, you can see how it dipped down into contraction territory. That's why the market was selling off. Same thing for job growth. You can see early in the year, job growth was fairly weak. In fact, in May, it was below 50,000. We saw a recovery in the second part of the year, and in fact, we finally started to see some wage growth, which we had been waiting for a long time. Small business optimism, again, you saw the weakness in the beginning of the year, and then after Trump was elected, you saw it spike higher. Now, small business optimism, Purchasing Manager Index, consumer confidence, they're called soft indicators because they're based on surveys. We really want to see the hard data, US GDP being the most important. And again, you can see early in the year down quite low growth and then a recovery in the second and third quarter. However, the fourth quarter, again, we saw economic growth go down. And this is something we've seen during not only this economic recovery, but the last few economic recoveries. If you look at this chart from the Wall Street Journal, you can see each successive economic recovery has gotten lower and lower. In fact, in the 1980s, the economic recovery, economic growth was over 4%. And then in the 90s, it was under 4%. In the 2000s, under 3%. And this recovery has been just over 2%. So it's a question of why is that? And I can tell you, there are lots of theories, but there is no consensus. So if we look at the symptom, the question is, why is the economy not great?